Nobody tells you what actually happens when you need cash during a market crash. But you've probably been following the standard advice to buy term and invest the difference in index funds. It sounds great on paper until life hits you with a job loss or a big business opportunity that requires money right now. And that's when the math starts to fail. If you try to touch those investments while the market is down 30%, you end up losing a huge chunk of your principal and paying taxes on top of everything. Financial gurus love to pitch buy term, invest the difference, like it's the only smart move for your wallet. But the wealthy actually do something completely different. They use whole life insurance as a financial shock absorber because they understand something about liquidity that most people completely miss. And they aren't being tricked by insurance agents or making dumb decisions. They're simply protecting their ability to move capital when the timing is right, which is a strategy that keeps them from selling their assets at the worst possible time. I'm going to show you why having access to your money matters way more than the rate of return debate that everyone seems obsessed with. Your invested difference is usually trapped right exactly when you need it the most. And you need to realize that this isn't a bug in the system because it was actually built that way on purpose. Let's talk about this buy term, invest the difference idea, because it wasn't created by a financial genius who figured out some perfect mathematical strategy. It actually came from a guy named Art Williams and his company Primerica back in the 70s and 80s as a way to disrupt the industry. You have to understand that this was always a sales strategy rather than a real financial plan designed to help build long-term wealth. It was built to move products rather than protect your family's future. The business model works by selling you cheap term insurance just to get a foot in the door, which acts as their primary lead generator for the rest of their services. They don't actually make their real money on the insurance side of things, but they get very rich by managing your investments and collecting fees on your assets. The insurance is just the hook they use to get into your wallet so they can move you into mutual funds where the real profit stays. And that's how they built a massive empire off simple advice. The pitch sounds logical because term insurance is much cheaper than whole life. So the idea is to take the extra cash and put it into the stock market. They talk about compound interest and time in market until it sounds like a sure thing. But the pitch completely ignores things like liquidity and taxes. The whole model assumes you live in a perfect world where you never need cash before you retire and the market never crashes at the exact moment you have an emergency, which just isn't how the real world works. This strategy only works if you're a robot who never deals with medical bills, job losses, or sudden business opportunities that require quick capital. The wealthy figured out a long time ago that real life is messy, so they structure their finances to have it as a buffer that keeps their investments from being interrupted. Once you pull money out of a brokerage account to pay for a crisis, that compounding stops forever, and the tax hit ensures you basically are starting over from scratch. We need to break down what happens when you actually need money in both scenarios, because that is where the buy term strategy usually falls apart. Let's walk through two different scenarios that happen to people every single day, and you'll see exactly where the standard financial advice falls apart. Scenario 1 is the absolute nightmare situation, where the stock market dips 20% and you lose your job at the exact same time. You suddenly find yourself needing $30,000 to cover your bills while you hunt for new work. But if you're following the buy term, invest the difference model, you're in a really tough spot. You log onto your brokerage account only to see your portfolio in the deep red, which means you have to sell $30,000 worth of investments at a massive loss just to get some cash in your pocket. But here's the kicker. Even if you sell those positions at a loss, you might still owe capital gains on some of your older holdings. The result is that you're essentially forced to pay the IRS while accepting a terrible price for your stocks. And that $30,000 is gone from your world forever. It will never have a chance to grow for you again because you had to kill the compounding machine just to pay your rent. Now, if you followed the typical advice and put the invested difference in a 401k or an IRA to get a tax deduction, you're in deeper trouble. If you happen to be under 60 years old, the government is going to take a massive cut out of whatever you pull out of those accounts. You'll have to pay your regular income taxes plus a 10% penalty just for touching your own money when you needed it most. On a $30,000 withdrawal, that penalty alone is going to cost you $3,000 before you even start start calculating actual income taxes you owe. You could easily see 30% or 40% of your money vanish into taxes and penalties, meaning the savings you thought were so efficient are getting destroyed by the IRS the moment you actually need to use them. That money is just gone, and it isn't coming back to help you later down the road. When you look at the future growth on that $30,000 over the next 20 years, you realize you basically just deleted a small fortune from your retirement. Maybe you think you can be a bit smarter about it, so you decide you won't sell at a loss and you'll take a margin loan from your brokerage instead. That sounds like a decent plan until you realize you're paying 6% interest to the brokerage firm, and if the market keeps sliding, you might hit a margin call. If that happens, the firm will force you to sell your stocks anyway to cover the loan. This puts you right back where you started. Plus, when you eventually scrape the money together to pay the loan back, you're sending that interest to the brokerage instead of keeping it for yourself. Scenario 2 is a lot more fun, but it creates a massive headache for most people. Imagine a great business opportunity pops up, like a killer real estate deal or a chance to get in on early on a friend's company, and you need $40,000 in the next 48 hours. In the buy term invest the difference world, you are once again forced to liquidate your assets to come up with the cash. You sell your index funds, trigger a bunch of capital gains taxes, and completely miss out on the opportunity cost of staying in the market. If the market jumps up 20% next year, you missed out on all those gains for the $40,000 you pulled out to do the deal. You're paying taxes today and losing out on growth tomorrow, which is a double hit to your net worth that most people never account for. This is exactly where the whole life buffer approach starts to look completely different. Instead of selling things off, you just take a policy loan at about 4% interest and call it a day. There's no tax consequences, you don't have to sell a single share of anything, and you aren't stuck waiting days for trades to settle. You call up the insurance company and the money shows up in your bank account ready to go. But here's the part that really blows people's minds. Your cash value keeps earning dividends even while you have the outstanding loan. The full amount of the money is still sitting inside the policy, earning 5 or 6% in dividends, even though you're technically using the same capital somewhere else. You might be paying 4% to borrow the money, but since you're earning 5% or 6% on the full cash value, your actual cost of capital is 0 or even negative. You're literally getting paid to use your own money, which is exactly how big banks operate. And now you're finally doing the same. You essentially have become your own bank. When the time comes to pay back the loan, you're putting that money back into your own system rather than handing it over to a third-party lender. The interest you're paying is staying within your policy, meaning the money never actually left your financial structure. You're just moving it around to different spots on your personal balance sheet. The policy works like a private banking system that gives you tax-free access to cash whenever you need it. The IRS doesn't even care that you borrowed the money because it's technically just a loan against an asset that you already own. This is a huge piece of the puzzle that the buy term invest the difference crowd never talks about. They get so hung up on comparing rates of return on a spreadsheet that they totally miss the massive advantage of liquidity. Having that liquidity is what keeps your main investment portfolio safe during times when life would otherwise force you to sell everything at the worst possible moment. I want to show you exactly how this works with some real numbers. Let's say you have a whole life policy and you're putting in $2,000 a month premium, which adds up to about $24,000 a year. After you've funded this properly over a few years, you have over $50,000 in cash value that you can access whenever you want. Let's say you need some cash for something important. Maybe it's a $40,000 down payment on a rental property, or maybe it's just a major emergency, but either way, you need the $40,000 right now. If you use the whole life loan approach, you take out a $40,000 policy loan at 4% interest, but your entire $50,000 cash value stays put and keeps earning dividends. If that policy is paying out 5% or 6% this year, you're paying 4% to use the money while earning 6% on the full amount, which means you're actually making a profit on the loan. You're quite literally getting paid to use your own capital to fund your investments and cover your bills. There are absolutely zero tax consequences for doing this. So you don't have to worry about capital gains or being forced to liquidate your portfolio. The money is yours to use however you see fit. Compare that to the buy term invest the difference way of doing things. You'll need that same $40,000, so you have to go to your brokerage account and pull it out. If you decide to use a margin loan so you don't have to sell, you're probably paying 6% interest on the borrowed funds. That is already more expensive than a policy loan, and the big difference is that you aren't actually earning anything extra on the money you borrowed. You're writing a check to the brokerage firm every month. But let's be honest, most people don't use margin loans. They sell their stocks. So you liquidate $40,000 from your investments, and let's assume you have about $15,000 in capital gains on that amount. You're going to owe $15,000 or $20,000 in federal gains tax, plus whatever your state wants to take. On the $15,000 in gains, you're losing anywhere between $2,250 and $3,000 to taxes immediately. And that's money you'll never see again. It actually gets much worse than that because you've also permanently stopped $40,000 from compounding in your brokerage account. If that money would have grown at 8% every year for the next 2 decades, you just gave up $186,000 in future wealth. You can't just put the money back in 5 years from now and act like you borrowed nothing, because that compounding clock has already been reset to zero. The whole life approach is different because it keeps every single dollar working for you even while you're using it. You aren't interrupting the compounding, you aren't cutting checks to the IRS, and you're actually just earning a spread on interest. This is the reason why wealthy families like the Rockefellers use whole life as a foundation for their wealth rather than just a replacement for their investments. Think of it as a financial shock absorber that protects your main investment portfolio from being raided when things get tough. Your brokerage account can stay fully invested through every market cycle because you have liquid reserves sitting somewhere else. You never have to sell your stocks at a loss, and you never have to pass up on a great opportunity because your cash is tied up. You don't have to choose between paying a bunch of taxes now or paying high interest to a bank later. The policy essentially becomes your emergency fund, your opportunity fund, and your tax-free bank all at the same time. This is the part of the strategy that the buy term invest the difference people never account for because they only care about the theoretical rate of return. They're not actually looking at things like access, liquidity, or tax efficiency. And that is exactly why their strategy often falls apart when real life actually happens. The big takeaway from everything we talked about today is that whole life insurance was never actually meant to beat the S&P 500. What this really is about is having liquidity and tax-free access to your cash whenever you need it. Because the whole buy term invest the difference strategy looks amazing on a spreadsheet, it usually fails in the real world the second you need to get your hands on some capital. Wealthy people use whole life as a buffer so their actual investments never have to be interrupted. And I want you to do a little bit of homework right now. Take a look at how much money you keep in your savings account earning basically nothing and compare that to what a policy structure could do for you. Many people have just $20,000 to $50,000 sitting in a bank earning 0.5% interest, which is exactly where your buffer opportunity is hiding. This strategy is not about replacing other investments, it's about protecting them. If you're ready to see how this works in your specific situation, go ahead and book a strategy call with me so we can map out exactly how this buffer strategy protects your portfolio while keeping your money easy to reach.